it's been an exciting week. This is the week of July 28th, 2022. And the couple of things that are pretty exciting. Number one, the Federal Reserve raised interest rates by 0.75%. That's a pretty substantial hike. We're going to talk about what that means to people and what it is. Also, we had a report on our GDP, the growth of the economy, and it slowed for the second quarter in a row, which puts us into the definition of a recession. So we'll talk about these two things by starting off with what is happening, what's the Fed trying to do? Well, let's go back and do just economics 101, supply and demand, and we'll talk about houses. Right now, we all have stories of people that have sold their houses for this gigantic amount. Why is that? Number one, a lot of people out there looking for houses. Number two, not enough houses. So when some house goes on the market, you may have 5, 6, 7 people bidding for that house because there just aren't enough. That's a function of not having enough supply of houses. High demand, low supply equals increase in prices. So that's economics 101. You just got an entire semester of economics in a couple of minutes. Now, the Federal Reserve has seen that we have inflation, and you've seen we have inflation. All you have to do is go to the grocery store and we see it. What inflation is caused by is basically too much money out there. There's too much money out there, and there's not enough supply of certain things such as gas or houses or used cars. So there's a lot of money, not enough supply, the price goes up. The Federal Reserve wants to fix that. What they can't do is do anything about the supply, but they can affect demand. And by pulling back on all the money that's sloshing around out there in the world, they're reducing demand, and that's what they're trying to accomplish. Now, let's take a step back. During COVID or the financial crisis, what did the Federal Reserve do? They printed lots of money and flooded trillions of dollars out into the economy. So that just gave lots of money out there to try to bolster the economy, increase demand, and really keep inflation in check and keep the economies from crashing. Well, part of that has caused the inflation that we're in right now, and they're wanting to pull back on it, and that's what they're doing. Now, one misconception is the Federal Reserve's funds rate that they just increased. All that is the overnight lending rate that banks charge each other to loan money overnight. How does that affect you? Well, frankly, it doesn't. But what it does do is it causes banks to pull money out of the system. They can now get a higher interest rate from each other, the Federal Reserve. So money comes out of the system and reduces the money supply. That's something that we're really looking at, is the money supply. Right now it's huge, but the Federal Reserve is pulling back on it, and that's what they're trying to accomplish. Is what they're trying to do is reduce demand. They can't do anything about supply, but if they reduce demand, prices should come down, and they in theory eliminate inflation. So that's what they're trying to accomplish. In fact, folks are worried about, well, how's that going to affect mortgage rates and credit card rates and various other things? Mortgage rates have nothing to do with this. So, in fact, mortgage rates have been coming down because there's a feature of longer-term interest rates that there's a piece of it is in future inflation, expectations for inflation. Well, if those expectations are coming down, the interest rate drops. So it's really not that big of a worry. The Federal Reserve is reducing demand. Now, how's that affect the stock market? Well, the stock market had quite the day on Fed announcement day. It went up quite a bit. The question I have, though, is why? Why would it do that? The chairman of the Federal Reserve looked right in the camera and said, we're going to keep doing this until demand slows. So they will keep doing it as long as we're out there spending all this money that's been sloshing around. That's what they can control, and that's what they will do. We are technically in a recession right now. So what does that mean for us? Well, frankly, The media likes to use that word recession as a scare tactic. But the fact is the economy is in one of two states of all time, all the time. You're either in a recession or you're headed towards a recession. That's it. There's two states the economy can be in. Whether we're in an official one or not, the White House differs from the actual definition of it, but you're going to hear a lot about it on the news. It really isn't anything to be worried about. A recession is something that we're already in. So another way to put it is the economy can be in one of two states. You're either in a recession or recovering from a recession. So if we are in one, what we have to look forward to is recovering from it. And that presents a lot of opportunities for investments and investors. So that's what we have for this week. Things can get a lot more complicated than this. So if you'd really like to get in the weeds and talk about economics, feel free to give me a call and we'll be happy to talk about it. We'll see you next week.